Hey guys, thanks for checking out the first FinPrep video here, weekly market update. Go ahead and pause the screen and read this disclaimer. Essentially, it tells you that the information contained in this presentation does not constitute investment advice. If you're seeking investment advice, contact a registered investment advisor. And the material in this presentation is for informational educational purposes only. So do not use this as a basis of action. Consult your registered investment advisor. Moving on, basically the point of this video and my subsequent videos will be to highlight market action, but most importantly to not only see what has happened in the past with respect to price and trend, volume and some other indicators, but primarily price, to kind of give us a view of what to expect as a potential outcome for the week ahead. So the sell-off, which began, kind of reminded folks that yes, you actually can lose money in stocks as well. A few weeks ago kind of caught at least folks I was speaking to off guard. So we're going to look at 6 signs of that things were ready to shift in the market, or had been shifting, and it was just sort of a matter of time before that shift became a bit more apparent. And wanting to be ahead of the curve, right, is probably a good strategy for your wealth. So here's the secular trend line. Here's a weekly chart on the S&P looking back at 2008 financial crisis lows and through 2011 here. The trend line was pierced in approximately July timeframe. Kind of without a hitch, at all-time highs, rather unannounced, kind of inglorious top, as it were, where potential top, that is, where the global secular trend for the S&P had been pierced. Multiple years in the making, and just a bit of a sell-off, so kind of nondescript. So there's your warning number 1, as it were. Our sign number 2 would have been this declining pattern of lower highs, which ended up creating a price channel, right? So you kind of see it's like a parallel price channel. Think of bowling lanes, as it were, with price now starting to hover below that blue line. A bit hard to see with all the price chop. But yeah, 2015 more or less was a fairly sleepy year, where you had price confined within the range here of approximately 198 on the SPY to 214, 213 as the top. So not very wide-ranging in terms of price, which is how sell-offs such as we had a few weeks ago catch people off guard, because you're essentially lulled into sleep with complacency. You're not really overly concerned unless you're in here in the markets looking at the stuff on a daily or weekly basis. So again, sign number 1, piercing of that secular trend line. Sign number 2, price beginning to drift in a series of lower highs. And that all culminated in a rather drastic price collapse, where we ever so briefly revisited the Ebola October 2014 lows. Price has since recovered, but has actually recovered quite smartly, actually, to the 61.8 Fibonacci percent retracement, which is just a big way of saying, if you measure from the peak of the price immediately preceding this kind of collapse, as it were, mini collapse, very quick correction, it recovered approximately 2/3 of its price, bang on. So fascinating stuff, as well as your symmetrical triangle, which we actually on Friday closed, depending on how strictly we draw trend lines, but we did technically close on the bottom side. So these tend to be continuation patterns, meaning they tend to forecast a resumption of the move which preceded it, although they can just as easily be reversal patterns where prices had a chance to coil, buyers and sellers kind of are doing battle, as it were, pushing it into a narrow range, and we see which way does it resolve. So we should expect to see a pretty decisive move in the next coming weeks, and we look forward to seeing how that resolves. Not too much more of this chop should persist, one would think, although anything can happen. Anything can happen in these markets. Okay, so that's the S&P. Looking at the Dow, you're going to notice it's more or less the same price pattern, although notice the pattern of declining tops I was referring to after the trend line break, which also occurs here in the Dow, it's a bit more pronounced, is it not, right? It's clustering towards the lower end of the trend price channel, and it seems to have begun earlier. But price well off, and actually a death cross would be the other technical indicator, meaning the 50-day moving average is crossing below the 200-day moving average, so shorter term price is declining to a greater extent than the longer term average of price, right? So that's one thing folks are looking at. That doesn't necessarily mean it's in a continual pattern. These things have a way of whipsawing around on occasion, but remains to be seen, actually, is how that's going to play out. So NASDAQ, QQQ ETF, a bit stronger. You'll notice prices clustering in towards the 250 daily moving average, as opposed to SP and Dow, which was further down here. So a bit of a outperformer, as it were, just visually looking at it from that respect. But same story, more or less, right? So downward price channel, and then your pierce of your long-term trend line. So bit different of a trend line, really. The long one kind of capped price and then established kind of a different base here at the end of 2012. But below it nonetheless, so interesting sign. So transports housed the item number 3, 4, and 5 in terms of warning signals of what was to come. And basically what we have here is in the beginning of this year and arguably into 2014 is a pattern of slightly lower highs in a downward price channel. So this, when you compare it with the S&P, right, where we actually had a pattern of rising highs and a bit of rising bottoms from this level to then this level. So telling you something was up in terms of Dow theory, that this is called negative non-confirmation. It's just big words of saying, hey, your S&P is going up, but your transport are going down. So something doesn't jive here. So we're not in sync. So this was sign number 3. This subsequently morphed into price breaking the 200 and 250 day longer term daily moving averages. There would be your sign number 4, particularly when it would cross below what was price support here. Just a lot of chop, indecision. You didn't really feel terrified. It was still holding the long-term trend line, but this told you, hey, this pattern gave. You're now below your 200 and 250 day moving average, and we then subsequently ended up piercing, although not in a devastating manner, but we did end up piercing that long-term trend line, as you just saw, with price actually moving up, kind of giving you perhaps a sense of false comfort, and then only to rally rather hard out of it. So interesting message coming out of the transports, and one not to be forgotten of. Negative non-confirmation basically, and just not seeing the follow-through that you're seeing in the headline index. Something to pay attention to always in terms of those who follow Dow theory. So something to keep on the back of the mind. Leading market sector has been biotech, so using the '08 lows to what was the top at 400, using IBB, the ETF, as a measurement. Basically, this has been a market leader. It's outperformed market by approximately a factor of 2, so it's gone up, let's say, 600%, whereas S&P had been at one point up 300% from the financial crisis lows. So you want to watch what happens with leadership, needless to say. So we had the sell-off in October where price briefly dipped below out of the price channel that had established beginning in 2014. This kind of higher price channel than the global trend. But subsequently recaptured and did a nice job following in and out and so forth. Arguably a head and shoulder pattern a bit compact though, actually, given the length of time it took to rise. But arguably a head and shoulder pattern within here, which did break down, so we lost that price channel. And actually, very interesting, now we're actually sitting at the global or secular uptrend from the 2011 bottom, sitting right there. Very interesting. And this is a declining wedge pattern, you could argue, although it could just be a trend line. But if it is a declining wedge pattern, that suggests the potential for a reversal. So the key question next week is what gives? Are the biotechs going to help lead and find price support at the 250 daily moving average and the long-term support trend and break out of this declining wedge, or does it fail and roll over, which would be hard not to imagine that would impact S&P. So next, looking at Treasuries, U.S. government long-term bonds, TLT, ETF 20 plus years, so considerable price movement given the duration of it. What we have is not a lot of safety in terms of protecting you from the price movement in stocks. But had a beautiful channel all through 2014. Nice price channel. Clearly some moves out of it, being capped precisely at, flipping to the weekly, this approximately 3-year top of the 2009-ish to 2012 to 2015 top. Just beautiful kind of sequence of tops, as well as following the trend lines. And so now here we sit sort of halfway between this longer term range that's in an upward direction, as you can tell. But still, it's just for me a bit of chop, a lot of just kind of not really respecting, as it were, trend lines and moving averages, just bouncing around them as if they don't even exist, hopscotch, as it were. So indecision with respect to Treasuries is at least my sense of it. So and pinched between your 50 and your 200 daily moving average. So not a trade I like to take. You tend to get moved around quite a bit, and it's unpleasant. So the question is, on which side will this price emerge? So that's keeping an eye on Treasuries. Looking at dollar index, massive rally, as you may be aware, beginning last summer, it looks like approximately July, capping off in the first quarter of this year, March, and drifting somewhat downwards, although this is more accurately, the trend lines aren't drawn here, but described as a sideways consolidation with 25, let's call it 75 as the resistance, and then support at 24, 25. So clearly that won't last forever. So the question is, again, similar to Treasuries, which way is it going to move? Well, that's a question anyways with anything. But that's what we're looking for in terms of resolution to our medium-term outlook with respect to the dollar. Oil's been quite interesting. So again, parallel fashion to what we saw in the dollar. You had collapse in oil prices, to be fair, and then a kind of parabolic rise in the U.S. dollar index. Sort of put in a very interesting double bottom here, as it were, kind of like a W-shaped, right? But got capped here. Got capped at 21. Price began moving in approximately, again, another wedge or triangle pattern, and then subsequently broke, again, kind of re-collapsed, as it were. Until quite recently, we had a massive surge off the ostensible or short-term low, shall we say, 1, 2, 3 days, and then coming in and forming to what is arguably a bull flag. So should price hold the 20 daily moving average and this lower bound of the bull flag, that would be interesting. Perhaps for a retest of 19, who knows? But definitely an interesting, although volatile, chart in the past week. So looking forward to watching the USO in the week ahead. Copper, Dr. Copper, is the other main commodity we'll discuss here. So 4-year, beginning with this 2011, basically forming the top of what is a downward price channel, and actually broke through it not too long ago. 7%, so it was a considerable pierce. You would think it's significant, and actually here's the following week. But you have this hammer, so even though price came in here, we'll zoom in on the daily. So one day where it popped back in, only to be slammed down. Volume's not really given a massive signal in terms of lit volume, but it is interesting to know, is this a throwback rally where we then potentially could end up rolling over in copper, i.e., rotating to the downside now that price channel has been violated, or does it recapture and then revisit 32-ish area? Or potentially lower if it takes longer, right? So, good to see. Interesting to see, that is. As well as, it's going to clearly, between the price action in oil as well as copper, is going to have an impact on the emerging markets, as well as what's going on with China's exchange. So not a terrific picture in terms of price going up for the emerging market stocks here. Pattern of lower highs and arguably slightly higher lows. So again, another triangle pattern stretching way the heck back to 2007, and then with a breakdown. Although we've seen these breakdowns before, short-lived, but this is multiple weeks. So something has shifted, clearly. And price really adhering to not currently breaking above the 20 DMA, although this clustering is somewhat interesting, although I suppose we have seen that in the past. So, yeah, just wanted to thank you guys for checking out my first video. Again, just a very, very quick recap. When S&P broke your long-term trend line, sign number 1. Sign number 2, pattern of lower highs, though it was ever so faint. You really kind of had to look with a magnifying glass to see it, but it did exist. Your transports, negative non-confirmation, index was going up in terms of S&P, but this was drifting sideways to moderately down. That's sign number 3. Sign number 4, prices started to begin to break below the 200 and 250-day moving average. And then breaking support here in terms of price support and clustering. So that was sign number 5. And sign number 6, we could turn to the Russell small caps, so more aggressive sector of the market, right? Basically, we had a similar pattern, but even to a greater extent slanted downwards, right, in terms of price trajectory for the Russell. So kind of carved out, and then wham, here was our slam a few weeks ago. So the signals were there. It did take some listening. It did take some paying attention, but we're going to continue to watch to see what happens looking ahead. What's going to happen with the biotechs? Can they make it out of, can they find support at the 250 and at the long-term trend line? Same thing with S&P. Do we revisit the Ebola lows if we break out of this symmetrical triangle, or can we make our way back up to 204 on this price support, or this 20 DMA at approximately 201? And then Treasuries trying to get a sense of direction of, okay, what's going on here? Are we going to chop around? And then which way are we going to get out of this 200 or this 50 daily moving average? So very interesting things, interesting times, very volatile times. Kind of the fun is beginning to begin. But so keep an eye on your wealth and your investments, because it is a storehouse of your time and your life. So treat it with caution. But consult a registered investment advisor in terms of specific investment recommendations. But guys, thank you very much for checking this out. I look forward to updating you next week. Take care.